I want to bring in Gus Faucher, Chief Economist at PNC Financial Services, now to continue this market conversation. So, Gus, I want to pick up on something that Emily had mentioned just to really highlight for everyone at home, because I think so many people are thinking, well, look, of course, we're going to see these inflation figures really spike in 2021, considering where we were just last year in the pandemic. So how concerned are you when you see figures like this? How much do you think some of these inflationary risks are going to continue to weigh on markets going forward?
I think inflation is overstated right now. If you look at the inflation rates from February of 2020 before the pandemic to May of 2021, they're actually a lot lower than the year-over-year numbers. So a lot of it is the base effects. And then we actually saw month-to-month inflation slow from April to May. So price increases in May were smaller than they were in April. So I think a lot of the inflation fears are overblown. I think we're dealing with some temporary shortages, with some temporary labor supply pressures. But I do expect that we will see slower inflation over the rest of 2021, and that, over the long run, the Fed is going to be close to its long run inflation target of about 2%.
Gus, that sounds a lot like what President Biden was saying yesterday when he held that press conference about the infrastructure deal with those bipartisan senators. He was talking about the Fed and inflation, and he also believes that it's transient. What makes you so sure that high inflation is not going to stick around for a long period of time?
The inflation that we're seeing is mostly in industries that have been impacted by the pandemic. So big increases in prices for things like used cars, for rental cars, for building materials, for air travel, that type of thing. And I think that those are just some temporary supply and demand dislocations. Demand for those goods and services is picked up. Supply hasn't picked up as quickly, but we will see supply adjust. And so I'm pretty sure that we're going to see supply adjust, that will help some of those price increases, and that we won't see inflation broadly throughout the economy. It's going to be close to that 2% average over the longer term.
So, Gus, I hear what you're saying about some of those inflation fears really being overstated. But I'm curious to know, and I think that so many folks are really laser focused on those rate hikes that could be coming down the line, particularly as we do see some of these spikes in some of those inflation figures. We heard from the Fed's James Bullard, who says, listen, rate hikes might be coming as early as 2022, not 2023, which is what the Fed had originally said just out of that meeting last week. Curious to know if you think that perhaps the Fed is going to have to make a pivot a little bit sooner than they have been indicating recently, although there has been some movement in those dot plots.
No, I think it's still likely that we won't see the first rate increase till 2023. The Fed has made it clear that they want the economy to be at full employment, and they want inflation to be consistently at or above 2% before they raise the Fed funds rate. I think we will meet those conditions by mid-2023. We will get a bit of Fed tightening next year through a reduction in asset purchases. That's pushing down longer-term rates. And so that will provide a little less stimulus to the economy. But I still don't think we'll see those conditions that the Fed is set for a rate increase until sometime a couple of years from now.
Gus, what do you think about the timing on the Fed starting to roll back its bond buying program? We didn't hear much about that in the last meeting. It seems as though the Fed is now starting to thinking about doing that. But do you think we're going to see that happen in coordination with the first interest rate hike?
Well, I think we're going to see the reduction in asset purchases is going to occur well before the first interest rate hike. Chair Powell has a Jackson Hole conference at the end of August. That's a big time for Fed chairs to make important monetary policy statements. So I would expect that when we get there, that Fed Chair Powell will announce that the Fed is looking at reducing its asset purchases. They said they want to give plenty of notice. So I would expect that the Fed will prepare the way, that we'll see them actually start to reduce those asset purchases in January of 2022, and then reduce them over the course of next year. And then that sets the stage for a rate hike in mid-2023.
Gus, how do you see that infrastructure bill? I know that it has not yet been signed. It's just right now a bipartisan deal that has been struck between those senators and the president. So it still has to face, the entire Congress. But do you see that at all weighing in on some of these inflationary figures, especially as so many are concerned that perhaps the economy is really accelerating in its growth?
That does have the potential to raise some inflationary pressures, particularly if the bill is funded primarily through borrowing rather than tax increases, user fees, that type of thing. The goal ultimately of the infrastructure package, the other pieces of it, is to increase economic growth over the longer run, increase the economy's capacity to grow. But in the short run, it could result in some stimulus and some greater inflationary pressures. But a lot of that is dependent on how it's financed, and we still don't have the details on that yet.
All right, we're going to leave that there. Gus Faucher, Chief Economist at PNC Financial Services Group, thanks so much for joining us today.